So you have a big pulse, if not, I don't know, you know what's going on in the economy. So talk to me about that. It looks like we have been, but I sound like a broken record. It looks like we've been in a recession for several months or we're going into one. What are you seeing in the general economy and what does that exactly mean?
With the caveat that I see it from a credit lens. I'm not an economist. I think that's a really important dichotomy. I'm that guy where the rubber meets the road.
That's where to
Um,
be though.
yeah, my job is to lend out money that you get paid back. You know,
Mhm. Yeah.
uh, commodity prices are telling me that we're in a recession. That it isn't as though the recession is nigh, and I can't cite any particular jobless statistics or anything like that. But I look as an example at the copper price, and I note that 7% of world copper supply is now suspended. Cobre Panama, Grasberg, uh, Kamoa Kakula. And the copper price, in the face of a 7% reduction in overall supply, remembering that prices are set on the delta between supply and demand, they're not set across 100% of the production chain. That 7% decline in production in a market that was already experiencing a production deficit has only led to a 5% increase in the copper price.
Mhm.
Tells me that near-term demand for copper is very weak relative to our expectations. I would have the same comment about oil and gas pricing and nickel pricing.
I was going to go there. Go ahead.
We are seeing a circumstance where, on a global basis, ex-Saudi and the U.S., frankly, uh, oil production at its best is cresting, and the oil quote is weak. That tells me that in the near term, there is near-term demand problems around oil and gas. So my spider sense tells me that on a global basis, it isn't as though we are approaching recession or that there's fear of recession, because I'm seeing demand softening in real terms, in
Mhm.
materials that get used to satisfy demand immediately.
Mhm.
As a banker, I see something else. I see the very beginnings of credit contraction. Uh, I see banks in the United States in particular that are dealing as best they can with at least three challenges. One is mark to market valuations on
Mhm.
their long term assets,
Mhm.
either their bond portfolios or their long term mortgage portfolios, where they've lent money for 8 years or 10 years at fixed interest rates. And then the interest rate went up. That lowers the net present value of their flow of loan repayments at the same time that they're financing that 8 or 10 year income stream with very short term deposits. So their cost of funds and deposits is going up and their yield is going down.
Mhm.
That's a time spread. That time spread issue is what wrecked the US savings and loan industry, and it wrecked Silicon Valley Bank. And I'm seeing it happen in real time to, in particular, big bank portfolios around the country. You will note, some of your listeners won't know, but you will note that through vagaries in accounting, the big banks are allowed to look at their loan and bond portfolios and carry them as held to maturity, which means that they aren't forced to mark their assets to market.
Mhm.
A bond could be selling in the aftermarket at 60, and if a bank had it in its held to maturity bucket, they could carry it on the books at 100, even though the market for the bond is 60. And there's beginning to be some very yawning valuation gaps between mark to market and what I call mark to myth. That's the first problem. The second problem is a persistent weakness in the United States in income, commercial, and industrial mortgages, particularly office mortgages, and particularly in big cities. We've seen one after another complexes that were 5 or 6 years ago valued at $700 million being sold at auction for 80 or 90 or $100 million. There's a lot of rot in bank portfolios around commercial real estate mortgages. There is a lot of extended pretend going on, but the circumstance around the market absorption of those projects isn't occurring. The third is that banks are beginning to be concerned about the whole range of what used to be called subprime or non-investment grade credits.
Hmm.
That could be consumer credit, which is to say consumer durables, uh, auto loans, credit card debts. But for 40 years, the rates on those loans were high enough that they could overcome the default rate. If you had a 5 or 6% default rate, but you were charging 25% on money that you were acquiring at deposit interest rates, which is say 3 or 4%, that
Hmm.
21% gross margin hit a lot of defaults in.
Hmm.
Uh, there is, I think, in this circumstance, a lot of rot left there. Let's say, as an example, that an Amazon employee making $20 an hour was able, albeit barely, to sustain his auto loan and sustain his revolving consumer debt, which is a fancy way of saying his credit card. But he got laid off this week. What was a strained but performing loan now is a distressed loan.
Hmm.
At the same time that the banking industry for 40 years has been able to extend credit to deserving commercial borrowers that were not investment grade, but borrowers who the industry was fairly convinced enjoyed tailwinds in their business and would ultimately be able to refinance at a lower cost of capital. With interest rates rising and credibility, pardon me, credit markets themselves, credit availability tightening, the
Hmm.
assumptions that were made around what were formerly deserving but non-investment grade credits is tightening up substantially,
Hmm.
and we're seeing that. When I sort of announced to the market a year ago that I looked forward to being myself an increasingly aggressive lender in the oil and gas business, in the royalty business, in the gas gathering business. I was astonished by the number of high quality but below investment grade borrowers who came to me. Private family offices that have traditionally had sort of $100 million revolving credit lines with money center banks, having the banks say, by the way, we won't be renewing.
Wow.
We're going in oil and gas to investment grade, triple B or better.
Hmm.
These are borrowers that have 40 or 50-year track records in the oil and gas business.
Gosh.
Businesses are in very good shape,
Hmm.
facing money center banks who are de-emphasizing non-investment grade credits and, oh, by the way, de-emphasizing oil and gas.
Hmm.
And I suspect, although I don't know, that that's occurring in other industries as well.
Hmm.
A private family might own a paint factory, very good business. Localized monopolies because paint is fairly cheap and very heavy to transport. So, as an example, a paint factory in Salt Lake City doesn't have to compete with a paint factory in Los Angeles.
Hmm.
I suspect that you're seeing private family businesses in a variety of industries beginning to experience um, credit availability problems that those families haven't seen since, say, 1982.
That far?
Yep. I mean,
Whoa.
listen, this period, 1982 to 2022, I think will go down in history as the most benevolent economic climate,
Yeah,
probably in recorded history. We had declining nominal and real interest rates. We had
sure.
very, very, very strong US dollar. We had great credit availability. We had great liquidity, money printing. We had
Hmm.
globalization where the cost of your inputs, if they came from elsewhere, came down. Um, it doesn't get better than that.
Hmm.
And it didn't. Beginning in
Hmm.
2022, both the nominal and the real interest rates went up. Various impediments to free trade came to occur. By the way, your taxes went up the whole time.
Yeah.
So while the next period won't be catastrophic, it also won't be easy. And people have been conditioned to expect easy, and their expectations must change.